Hello and welcome to Link America. Today we will be talking about yield farming. Before starting, make sure to hit the like button and subscribe to our channel for more future updates. Yield farming is the practice of leveraging decentralized finance to optimize returns. Users lend or borrow crypto on a DeFi platform and receive Bitcoin in return for their services. Yield producers who desire to boost their yield production might apply more complicated strategies. For example, yield farmers can continually transfer their cryptos between several lending platforms to improve their earnings. How does yield farming work? Income farming allows investors to earn yield by depositing coins or tokens in a decentralized application, or DApp. Examples of DApps include crypto wallets, decentralized exchanges, decentralized social media, and more. Yield farmers often utilize decentralized exchanges to lend, borrow, or stake coins to earn interest and speculate on price movements. Yield farming across DeFi is supported by smart contracts, bits of code that automate financial agreements between two or more parties. There are many types of yield farming. Liquidity provider. Users deposit two currencies to a DEX to enable trading liquidity. Exchanges charge a nominal fee to trade the two tokens, which is paid to liquidity providers. This charge can occasionally be paid in new liquidity pool tokens. Lending. Coin or token holders may lend crypto to borrowers using a smart contract and receive yield from interest paid on the loan. Borrowing. Farmers can use one token as security and obtain a loan of another. Users can then cultivate produce with the borrowed currency. This manner, the farmer preserves their initial holding, which may improve in value over time, while also collecting yield on their borrowed coins. Staking. There are two sorts of staking in the realm of DeFi. The main form is on proof-of-stake blockchains, where a user is paid interest to pledge their tokens to the network to guarantee security. The second is to stake LP tokens generated from supplying a DEX with liquidity. This lets users to earn yield twice, since they are compensated for delivering liquidity in LP tokens, which they can then invest to gain more interest. Calculating yield farming returns. Expected yield returns are normally annualized. The anticipated returns are computed over the course of a year. Two often used measures are annual percentage rate and annual percentage yield. APR does not account for compounding, reinvesting gains to create higher returns, but APY does. Keep in mind that the two metrics are only predictions and guesses. Even short-term gains are difficult to foresee with certainty. Few of the popular yield farming protocols include Curve Finance, Aave, Uniswap, PancakeSwap. Risks of yield farming. Yield farming is a sophisticated operation that exposes both borrowers and lenders to financial risk. When markets are unstable, consumers run an elevated risk of temporary loss and price slippage. Some concerns linked with yield farming are below. Before moving ahead, secure your internet in crypto while doing yield farming by using NordVPN, and get 60% off on your plan by using the link in the description of this video. Rug pulls. Rug pulls are a sort of an exit scam in which a cryptocurrency developer takes investor cash for a project and then abandons it without returning the payments to the investors. Rug pulls and other exit scams, which yield farmers are particularly vulnerable to, accounted for about 99% of big fraud during the second half of 2020. Regulatory risk. Cryptocurrency legislation is still clouded in ambiguity. The Securities and Exchange Commission has decided that some digital assets are securities, placing them under its jurisdiction and allowing it to regulate them. State regulators have already issued cease and desist orders against centralized crypto lending services like BlockFi, Celsius, and others. DeFi lending and borrowing ecosystems might take a blow if the SEC classifies them to be securities. While this is true, DeFi is meant to be resistant to any central authority, including government rules. Volatility. Volatility is the degree to which the price of an investment changes in either direction. A volatile investment is one that has a big price swing over a short period of time. While tokens are locked up, their value may decrease or rise, and this is a major risk to yield farmers, especially when the crypto markets undergo a bad run. This concludes today's video. What are your thoughts on our list? Please let us know what you think in the comments section below. Also, don't forget to like us and subscribe to our YouTube channel for future updates.